What's going on, everyone? It's Nick with Us versus Herd. We're here on Fed Day, getting things going. How you all doing today? It's been a while. I haven't been streaming or making content, but I feel like today was one of those days. You know, you gotta buck up. You gotta document what's going to happen today, because I mean, today is obviously today's an historic day. Say what's up in the chat. You guys hit the like button, definitely appreciate it. Yeah, I got some roasted almonds here. I got a root beer. I'm ready to kick it with you guys with the Fed. See what's going on here. Expectation wise, where we're at today. Expectation wise, looking for a 0.5 point rate hike. Also looking for markets are preparing for a hawkish Fed, and the central bank is also expected to announce a plan to cut its roughly $9 trillion balance sheet by $95 billion a month, beginning in June. So, kind of see what's going on. But I'm glad to be here. I'm happy. I'm glad to be making some content here. Glad to be chilling live with you guys, UVH fam. I mean, I've been very active, even though I haven't been on YouTube. I've been very active in the Discord. So if you're not in the Discord, go ahead and join the Discord. It's in the description. Link is in the description for that. But yeah, I've been doing good. Got my Star Wars shirt on today. May the 4th be with you. But I mean, in terms of price action today, if we're looking at we'll wait for this to come on. But if we're looking at the price action for today, I mean, this is the Nasdaq. Nasdaq just cratered by like 200 points, ripped back up, V-shaped recovery. S&Ps, same exact situation here, cratered back up here. Everything is green. Well, I mean, I guess, S&P's up 0.25%, Nasdaq's flat, Dow's flat, Russell's struggling, gold's struggling, Bitcoin's up a little bit here. Oil is getting rocked right now. I mean, oil is doing some numbers. It's like China's basically shut down, and oil's at trying to break out of this wedge here, right? But oil is just ripping. Just post over here in the Discord. One second. Just post in the Discord. All right. Wish I could thumbs up twice. Appreciate that. Yeah, I'm interested to see what's going to happen to oil here, because Biden in the White House, they're trying to release a third of our reserves, and they said we're going to save 10 cents to 20 cents a gallon. And China's not consuming any oil right now. I mean, this is crazy. And if China opens up, I mean, what do you think? Is it going to go to $200? $200 a barrel? I could see $200 a barrel happening for sure. I mean, we'll see what happens. I don't want to scare anybody, but I mean, things aren't good. Things are not good. I mean, I've live streamed and made content, during great times, easy times, COVID during horrible times. And now we're back to not so great times. And that's just part of being a trader. Like if you were successful 2020, 2021, and you gave up already. And I mean, I know we've had, if we're looking at the S&Ps, I mean, we've had a rough ride this year. I mean, we've basically had 4 months of downtrend. I mean, S&P's holding up a lot better than the Nasdaq, and Nasdaq, I've been trading a lot of Nasdaq futures. Nasdaq is just getting demolished here. I mean, I've been looking for Nasdaq to come back above the 10-day moving average. Looks like it wants to, but I mean, the last time we tested the 10-day moving average here was April 21st. Yeah, Jeff, we're waiting for Papa Powell. So we got about 4.5 minutes before those notes come out. I do have the CNBC up. I'm also waiting for Powell. Powell will be coming on at 2:30 Eastern time, 1:30 Central time. So I'm waiting for. We're gonna stay in the know here. We're gonna stay in the know. I don't know how'd you guys do on trading today? For me, I was 2 for 3 today. So basically, won 2 trades, lost 1 trade, made like 200. Not great, but Fed days are not my strongest days. So I feel like if I go 2 for 3, call it quits. Call it a wrap. Yeah, Stock Wolf, I got you, man. FC, pure calls. What we gonna YOLO? Well, I guess you could. The thing is, like, what we've been seeing in terms of the Fed when they released their statement. Well, we've been seeing like a huge rip, and then we've seen crater after that. So like people get excited and they start buying. Like I think the best thing that we could do when the rate announcement and their programs are announced, just take it easy. Don't get too excited. Like everybody nowadays, they see like a rip and they get so excited because it's like, oh, I haven't seen a rip since the last time the Fed did this. I haven't seen a green rip in a long. Oh man, the markets are green. I mean, take a look at it. I mean, we're still. I mean, we're chilling at the bottom. Like, don't get too excited. We're chilling at the bottom. S&Ps chilling at the bottom. I mean, we almost made a new low, a new 52-week low just 2 days ago. So like, no need to get excited here. It hasn't actually broken any trends or anything. It hasn't, So don't get too excited. That's all I'm going to say is like, I'm just take it easy. Take it easy. And if you're not profitable, if you weren't profitable this morning, you're not going to be profitable this afternoon. So just stop. Stop yourself. Take it easy. All right, we got 2 minutes until the minutes are coming out, so we're gonna see what happens. Let's all right, VIX is coming down. We could put ES up here. We could put Nasdaq down here. Let's see what we're doing. Little pump here. What do you guys think? I mean, the Fed's not known to surprise, right? So what do you guys think? We're going to have half a point? I mean, probably that's what we're expecting, right? If it's not half a point, if it's a quarter point, we rally hard. If it's 75 basis points, we rip to the downside. Buys rolled in 2 minutes. Here we go. All right, so yeah, we got 1 more minute here. It's gonna be interesting. This is. I mean, to be honest with you, this is gonna be something we're gonna remember forever. However this pans out with these interest rate hikes and all this stuff, we're gonna remember this forever for the rest of our lives. Good or bad. Good or bad. 100 basis points. Your 401k is going to be cut another 50%. But I mean, I guess they're kind of expecting by the end of 2022 like another 200 basis points by the end of 2022. So I guess we'll kind of see how this happens. I mean, people are like, why are they doing this? Is raising rates and crashing the market is way better than high inflation, and that's the issue. There's not a good answer here. It's the lesser of the two evils. All right, so let's see what they're gonna do here. We're getting Don't trade this. Don't trade this. Don't trade this. Yeah, see, I miss doing them. I need to get back on. I mean, I know I haven't been myself lately. I need to get back on game here, A lot going on. All right, this is some wild price action right now. VIX is popping up here. I mean, all right, so we're getting some price action here. Fed raises rates by 0.5 percentage point, the biggest hike in 2 decades. All right. Along with the move higher in rates, the central bank has indicated it will begin reducing asset holdings on its $9 trillion balance sheet. The Fed had been buying bonds to keep interest rates low and money flowing through the economy, but the surge in prices has necessitated a dramatic rethink in monetary policy. Yo, it's just so funny to me, like, the surge in prices has necessitated a dramatic rethink in monetary policy. Like, guys, anyways. The plan outlined Wednesday, we will see the balance sheet reduction happen in the phases as the Fed will allow a capped level of proceeds from maturing bonds to roll off each month while reinvesting the rest. Starting June 1st, the plan will see $30 billion of treasuries and $17.5 billion on mortgage-backed securities roll off. After 3 months, the cap for treasuries will increase to $60 billion and $35 billion for mortgages. So, clinch them cheeks, boys. Those numbers were in line with discussions. Yeah, I mean, I think the thing is that what we haven't seen yet out of the Fed is any surprises. Everything that we've have expected from the Fed and Powell has happened to the T, exactly to the T. Because I think Powell is so scared of disrupting markets that he's following his instructions to the letter right now, right? Markets now expect the central bank to continue raising rates aggressively in the coming months with a possible 75 basis point hike on the table for June. Wednesday's rate hike will push the Federal Reserve Fund's rate to a range of 0.75 to 1%, and current market pricing has the rate rising to 3 to 3.25 by year's end. Get ready for those 10% mortgage rates. But I mean, they're going to crash the housing market. They're going to crash the market, and then they're going to lower rates, and then the market will recover. I mean, this is the rinse and repeat, right? The rinse and repeat. Right now, we're at the beginning, and I keep telling people like message me and stuff like, oh, do you think? I mean, listen, I don't know what you want to do with your own money, right? I don't know what you want to do with your money. But what I will say is we're at the beginning stages of whatever's happening. So if you like what's happening, keep doing you. If you don't like what's happening, find out some other ways to protect yourself. That's all I'm going to say. I can't tell you what to do with your money. Everyone has their own goals. Everyone has their own, we're all adults here, I don't know if we should be buying SPY or selling SPY. I mean, right now I'm specifically day trading. Like, I'm not even really swing trading. I'm just, So if you're doing well in this market, just keep doing that. If you're not doing well in this market, you're gonna have to change. It's what it is. We always have to change. We always have to shift. Buy gold and silver. You think gold's gonna be the hedge? You think there's a hedge? Right now, the hedge, they're like, oh yeah, we're at 8% inflation. Buy stocks. Okay, when you have stuff like Lyft and Uber down 30%. You got Facebook down 40, 60%. You got, right now, cash is king, right? People don't like cash because they've been talking about cash is trash for the last 5 years. Cash is looking pretty good right now. Cash is looking pretty good. Deploy, and there's going to be, the thing is, there's going to be opportunities to deploy our capital, right? So now may not be the time, but there's going to be a time, and you're going to know. You're like, when will it be the time? You're going to know. You're going to know when the time will be. We will all know when the time will be. But right now, it's to prepare for war. I mean, if you haven't been preparing, it's not too late. You can still prepare, but like, and you know, honestly, I hope the market just recovers and where everything's fine. But prepare for the worst. You know, prepare for the worst. That's all I'm going to say. All right, so we're gonna leave this on. Let's take a look at some charts here, so we kind of know what's going on here. We're gonna wait for Jay Powell to come on in about 25 minutes or so. Sitting in 70% cash reserves. Yeah, I mean, like, we're gonna have great opportunities, and a lot of new traders. A lot of new traders come around and they just want something to do. They have to do something with their hands. Like, I need to do something. I need to do something, and the best way to make money in the market is to be patient and wait for the opportunity. But as a new trader, you want to do something, right? You want to do something. I encourage you to refrain from that because whatever you're doing now is most likely too early. You know? I'm not saying short or anything because I mean we could have some massive rallies. I mean, if you look at the S&P here, we had back in March, massive rally just to give it all back. I mean, we had 2 weeks of up, 3 weeks of down. I mean, it's bad. It's bad. Nasdaq, I mean, tech has freaking gotten smashed. Now, the only thing that's really doing well, you know, I would say Apple. Apple's still doing fairly well. Still above the 200-day. I mean, we dipped below the 200-day moving average here, but I mean, it's holding. It's back above the 10-day moving average. Apple's holding strong. Microsoft not as good, but there's not a lot of other places to go to park your capital. Apple doing $90 billion share buyback programs. Yo, Daniel, what's happening? Google, I mean, all these stock splits. I mean, Google had announced a stock split. Amazon announced a stock split. And that was up here. And now we're going to be, you know, a lot of these stocks are going to be losing a third of the value by the time we have a stock split, right? What was the other company that was doing a stock split? Was Shopify. I mean, Shopify announced a stock split, and the market said, "Hold my beer, I'm gonna do it for you." Right. The only thing you're not going to get those additional shares that you were promised. I mean, Shopify chart is just straight implode crater. I mean, it's horrible. It is horrible. Horrible. Boeing, horrible. I mean, Boeing's been having a bad time for a while, but I mean, this is just unbelievable. This is just unbelievable, right? I mean, were we in a bubble? I mean, absolutely. But like, the thing is, you don't know like when the bubble's gonna pop. So, like, as a trader and an investor, you'll go along with it until something changes, right? I mean, China stocks. Look at Alibaba. I mean, Baidu. I mean, it's a disaster. I mean, this is ugly. Actually, Tesla's doing pretty well. I mean, Tesla's right on the 200-day moving average. It's going to get squeezy here. You know, Elon sold a bunch of shares, caused it to crater like 200 points back up here. I guess. I mean, I honestly think that, I mean, Tesla's probably going to do well, unless there is like a market crash. Like, we haven't really seen much fear in the market. Everything that we see now is pretty controlled. All right, S&Ps are holding. Nasdaq's down a little bit. Yeah, these 1 minute. When did the Fed start rolling like previews before the? Come over here. What's going on here? Like, the Fed started rolling out previews before they're pushing out their initiatives. So. Oh my goodness. Yeah, I mean, I wouldn't want to put on anything before Powell. Yo, Chase, what's going on? We're trying to get some tendies, man, but, they're playing hard to get. Yeah, Jeff, I agree with you, man. Like, this is not as strong of a spike compared to the last rate hike we did. Last rate hike, we got a crazy spike, and then it sold off hard. This looks like death. Like Powell comes on with freaking, Dow's down 800. I don't want to scare you. The way I see it right now, I mean, this is looking rough. S&P, I mean, we're treading water here. Just be careful. Nasdaq had a 100-point swing just here in just a couple minutes. If you guys could do me the favor, hit the like button. Definitely appreciate it. You guys think Twitter is going to spike because of Musk? Like, I think that the market on Twitter is pricing out that Musk doesn't get the deal done. Because if they did, it wouldn't be hovering at like 48 right now. I don't know. What does this chart look like? Do these charts look slow? Like, what's going on here? It's like the chart looks slow. Either the data's lagging or... Probably the systems are like overwhelmed. Yeah, I mean, what do you guys think? I mean, this looks it looks sus. I would say kind of a weak reaction prior to Powell on here. Yeah, I mean, I actually have had a lot of people hit me up about Twitter, and like I would just be careful. Like the market is, I mean, he's looking to buy it at 54.20. Twitter right now here is at 48.47. Why is it trading below what the purchase price is? I mean, if you want to take a small position, you can, but if the deal for Twitter doesn't go through, I mean, that thing's going to 30, maybe even 27, 28, That's the risk. Like, you wouldn't want to risk money that you care about. If you want to, I would say right now the market's pricing in that the deal won't be done. Especially like, Musk putting up Tesla shares to fund his purchase of Twitter. But right now, these guys are eating premium. J. Kush, SPY, 405, 406 would be nice. And you want a 10-point drop from here, man? Oof. Yeah, we got another 15 minutes before the Fed comes on. Right now, there's kind of there's like no reaction. I mean, we swung pretty big in both directions, but now we're kind of back to where we were prior to the rate announcement. Yeah, I mean, I think Powell's going to be the one that's going to help the situation or hurt the situation. The ultimate thing is if they like pinned it here and they just ate those options up today for those that are expiring today. Because what today's Wednesday, so you got SPX, you got SPY, Qs, right? They would just eat those up. But I mean, so far, I would say this thing's looking terrible. TD stripping real-time data. I don't know, man. This seems like it's like a bottleneck or something, because this price movement is moving a lot slower than I feel like it should be. I don't think it's my connection. I'm hardwired in. I'm good to go. Is it moving slow? Is it moving slow on your guys' computers too, or is it just me? Because it seemed like it was moving a lot better before the rate decision. And now, I mean, it might be just be bottlenecked on the network for them. VIX is chilling. You getting screwed on Twitter. I mean, Apple's still holding green. The banks are up. Yeah, right now we're trading. Yes, no one wants to buy. Okay, yeah. Everyone's like, you go first. No, you go first. No, you go first. No, please, you. I insist you go first. No, I don't want to be the first, but how about you? Anybody who trades this price action, I mean, you're a wild boy. You are wild. Wild. What about Lyft? And did Lyft crack 20? No. Yeah, I mean, Lyft is gone, man. This is gone. This is gone. It's I think, I mean, I actually tweeted this a couple months ago. I was like, okay, with record high gas prices, how is this going to impact Uber and Lyft? Because I mean, like, you at some point in time, my actual tweet was, at what point does driving for Lyft become, or Uber become, unprofitable with gas prices? Well, I think we found out. And, you know, they're trying to put incentives for people, but, like, I mean, I hate to say it, but would you rather go work at McDonald's for $15 an hour and not drive around, or drive around and lose money? I mean, you're making $15, $20 an hour right now at McDonald's. Uber is not looking that good. Lyft's not looking that good. Like, when gas prices are low, and sure, maybe if you have an EV, but EV prices are you know, pretty expensive. You know, you're looking for 50, 60 grand a car. I don't know. I think Uber and Lyft are going to have a hard time. I mean, Uber's way better than Lyft right now, but oof. Oh yeah, gas has been way more expensive, like double this. I was telling somebody. So, like, back in, like, this was like a long time ago when Obama was president, and I was like the most broke I ever been my whole life. Like, I was putting in like $1 to get to work. You know, I was just working at I was just a Starbucks barista. I was working at Starbucks, and gas was like $6-7 here in Illinois and Chicago. And I was only making $8 an hour or something like that, right? I couldn't afford, like, some days I didn't know if I was going to make it to work because I didn't have the money. That's how bad it was. I just didn't know. I didn't know if I was going to make it to work. It's like, gas was the highest when I was the most broke I was my whole life. So can gas go? I'm anticipating gas to double from here. I'm almost expecting it. You know, who this is really going to hurt are, you know, young people, lower class, and people that are trying to retire. Everybody else will be fine. Middle class, upper middle class, be all right. I got my first car in 08 when gas was $4. That was rough. yeah, I mean, it was. I just remember I couldn't afford it. I just couldn't afford to put gas in my car. I used to live out of a Honda Prelude with a sunroof that leaked while living in a rainforest. Oh my gosh. Yeah, I mean, the good news is like we can reflect on those humble times and be grateful that we went through them. I mean, at the time it sucked bad, right? You're just like, oh God, here comes the dump. You know, you think about those humble times, you're like, man, I'm glad I'm not there anymore, right? But right now, that's somebody's time, right? Somebody else is going through that time right now where they don't have anything. Like there was a point in time where I had nothing. A lot of people had nothing. I wasn't born into anything, right? I didn't have any money. I was working at Starbucks, and I was a waiter at a restaurant, server at a restaurant. You know, had no future, no hope, no money. But I mean, at some point in time, you have to say enough is enough. Put your foot down and make some real change, you know? Otherwise, I mean, nothing's going to change unless you change it. You're going to be broke a long time. Or we got like 9 minutes or 8 minutes before Powell comes on. This thing's dumping right now. Yeah, we're in trouble here, man. Yeah, this is bad. Yeah, see, I agree. Yeah, we got Powell coming on. People are like, dump it, dump it. We didn't get the spike we wanted. Dump it. Man, I just, yeah, just reflecting. I mean, can gas get higher? Absolutely. Absolutely. A lot higher. Like $10 a gallon, $12 a gallon, I bet. Because, I mean, even if you factor in inflation over the last 10 years, if you factor in inflation, gas is still below average. For a long time, we've been, I mean, because we had the pandemic and, you know, but gas, if you factor in inflation over the last 10 years, gas is actually still, like, if you're paying like $4.50, $4.45 a gallon, you're still paying below inflation levels if it were to remain the same. Like, if you're paying $3 10 years ago, you should probably be paying, you know, close to 5, 6 now. Not saying that's anything we want to do, but I'm just saying. So I think like if gas stays around here, we should be able to handle it. But gas goes to double what here, triple here. I mean, people are gonna be getting effed up. If they don't start drilling our gas, it's gonna be a bad spot. Yeah, I mean, especially, you know, with we got war in Europe. I mean, we got all sorts of things messed up. All right, it's trying to rebound. Yeah, don't trade this, guys. This is. Somebody's getting. If you haven't gotten your account blown up already, I mean, don't let it be today. Don't let it be today. I mean, a lot of people are getting blown up. If you're still trading right now, that's why I don't know how, like, what turnout's going to be for like live streams and stuff, because like a lot of people that watch probably gotten. Even like, that's crazy to me that people get blown up accounts. They could watch this channel every day and blow up their account. And I'm probably the least aggressive trader on YouTube. You know, get the drive to California for my kids. The capping wells down here in Louisiana. Feds haven't renewed licenses in the Gulf yet. Yeah, bro. I think we screwed. Yeah, I was gonna say. California, yeah, you're gonna have to go. I don't know. Hopefully, maybe Canada can help us out with some oil. You know, we're in trouble. We're in trouble. We're gonna have 10%. We're gonna have 10% mortgage rates, $12 gas. So far, the trend is looking like it wants to be down. You know what I mean? I mean, this could change at any time. I mean, we're waiting about 4 more minutes. 4 more minutes in. 4 more minutes in. Powell's gonna be on. I'm just waiting for. Almost waiting for him to pop up over here. I don't know if Canada is cheaper than. Well, yeah, we're. I'm just waiting for this. I'm just waiting for the Fed to come on. So hopefully he's on time. Oh wait, how'd you guys trade today? Did you make any good trades? Not so good trades. I mean, it's okay to admit it. Post your losses. Be proud of. I mean, if you never had any losses, you'd never learn anything. You know. Yeah, we are looking at Venezuela for oil. And the problem with like Africa is that China controls all the ports. Watch Chairman Jerome Powell news conference after the Fed's biggest rate hike in 2 decades. Yeah, these wicks are wild. $420 call for meme purposes. It worked out just one contract. You can buy the SPY 420 call right now. You could. It went in the money after I sold it. That's how it goes, man. At least you're protecting your capital, you know. I mean, you don't know what's going to happen here. I mean, they're trying to rally this. They're trying to rally this up now before Powell gets on. We're always chugging along through the good times, through the bad times. All right, so we're gonna watch the Nasdaq here, ES here, and we're gonna get the conference on over here. This is for super traders, aka the people who want to blow up their accounts. Yeah, if you want to be a superhero, go ahead, but you probably won't be able to trade tomorrow. I will. Like, you have to ask yourself a question. Before you put a trade on, you have to ask yourself a question that's maybe risky. It's like, if this goes bad, will I be able to trade tomorrow? If the answer is no, don't do it. Just don't do it. It's honestly not worth the risk. All right, so we got S&P here, Nasdaq here. We're going to be watching over here. Powell should be coming on. He's usually on time, unlike Biden. Takes Biden a while to, take a leak, a lot to clean up. All right. I won't throw any more shade. Honestly, I don't care for Trump or Biden, so say what I want. I'm about to get shadow banned on YouTube now. Nice knowing you guys. My last live stream. Let's refresh this page. Make sure we got the latest data from the Fed. I know that was bad, but I just sometimes you can't help yourself, All right, let's see what I'm not gonna start the audio until we see somebody, because it's just people just like chit chatting. So I'm not gonna start it up yet. Mr. Powell. All right, so we got the S&P up 18 or 15. It's a wild right now. Dow's up 200 and Nasdaq is down or up 1, down 20. I mean, and this is moving. Oh, here he is. Let's get this popping.
Good afternoon.
Let me know if you can hear okay.
See everyone in person for the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to restoring price stability. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point and stated that it anticipates that ongoing increases in the target range will be appropriate. We also decided to begin the process of reducing the size of our balance sheet, which will play an important role in firming the stance of monetary policy. We are on a path to move our policy rate expeditiously to more normal levels, assuming that economic and financial conditions evolve in line with expectations. There is a broad sense on the committee that additional 50 basis point increases should be on the table at the next couple of meetings. We'll make our decisions meeting by meeting as we learn from incoming data and the evolving outlook for the economy. And we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal. With regard to our balance sheet, we also issued our specific plans for reducing our securities holdings. Consistent with the principles we issued in January, we intend to significantly reduce the size of our balance sheet over time in a predictable manner by allowing the principal payments from our securities holdings to roll off the balance sheet, up to monthly cap amounts. For Treasury securities, the cap will be $30 billion per month for 3 months and will then increase to $60 billion per month. The decline in holdings of Treasury securities under this monthly cap will include Treasury coupon securities, and to the extent that coupon securities are less than the monthly cap, Treasury bills. For agency mortgage-backed securities, the cap will be $17.5 billion per month for 3 months and will then increase to $35 billion per month. At the current level of mortgage rates, the actual pace of agency MBS runoff would likely be less than this monthly cap amount. Our balance sheet decisions are guided by our maximum employment and price stability goals, and in that regard, we'll be prepared to adjust any of the details of our approach in light of economic and financial developments. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Nick Chairman-Rosa, The Wall Street Journal. Chair Powell, the unemployment rate at 3.6% in March is now essentially at the level that the committee had expected would prevail over the next 3 years, and at the bottom end of FOMC participants' projections for the longer run rate that you submitted in the projections at the last meeting. How has your outlook for further declines in the unemployment rate changed since March? What does this imply for your inflation forecast? And how has your level of confidence changed with regard to the feasibility of slowing hiring without pushing the economy into recession? Thanks.
Thank you. So you're right, 3.6% unemployment is just about as low as it's been in 50 years. And I would say that I expect, and committee members generally expect, that we'll get some additional participation. So people will be coming back into the labor force. We've seen that, particularly among prime age people. And that will, of course, tend to hold the unemployment rate up a little bit. I would also expect, though, that job creation will slow. Job creation has been at more than 500,000 per month in recent months, very, very strong, particularly for this stage of the economy. And so we think with fiscal policy less supportive, with monetary policy less supportive, we think that job creation will slow as well. So it is certainly possible that the unemployment would go down further. So I would expect those to be relatively limited because of the additional supply and also just the slowing in job creation. Implications for inflation, really the wages matter a fair amount for companies, particularly in the service sector. Wages are running high, the highest they've run in quite some time. And they are one good example of, or good illustration really, of how tight the labor market really is. The fact that wages are running at the highest level in many decades. And that's because of an imbalance between supply and demand in the labor market. So we think through our policies, through further healing in the labor market, higher rates, for example, of vacancy filling and things like that, and more people coming back in, we like to think that supply and demand will come back into balance, and that therefore wage inflation will moderate to still high levels of wage increases, but ones that are more consistent with 2% inflation. That's our expectation. Your third question was?
Your level of confidence that you can slow hiring without pushing the economy into a downturn.
So I guess I would say it this way. There's a path. There's a path by which we would be able to have demand moderate in the labor market and therefore have vacancies come down without unemployment going up, because vacancies are at such an extraordinarily high level. They're 1.9 vacancies for every unemployed person, 11.5 million vacancies, 6 million unemployed people. So, and we haven't been in that place on the vacancy, sort of the vacancy unemployed curve, the Beveridge curve. We haven't been at that sort of level of a ratio in the modern era. So in principle, it seems as though by moderating demand, we could see vacancies come down, and as a result, and they could come down fairly significantly, and I think put supply and demand at least closer together than they are, and that would give us a chance to have get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple of reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You talked about using 50 basis point rate hikes or the possibility of them in coming meetings. Might there be something larger than 50? Is 75 or a percentage point possible? And perhaps you could walk us through your calibration. Why 1 month or one meeting should we expect at 50? Why something bigger? Why something smaller? What is the reasoning for the level of the amount of tightening? Thank you.
Sure. So 75 basis point in an increase is not something the committee is actively considering. What we are doing is we raised 50 basis points today, and we've said that, again, assuming that economic and financial conditions evolve in ways that are consistent with our expectations, there's a broad sense on the committee that additional 50 basis point increases should be on the table for the next couple of meetings. So we're going to make those decisions at the meetings, of course, and we'll be paying close attention to the incoming data and the evolving outlook, as well as to financial conditions. And finally, of course, we will be communicating to the public about what our expectations will be as they evolve. So the test is really just, as I laid it out, economic and financial conditions evolving broadly in line with expectations. And I think expectations are that we'll start to see inflation, flattening out, and not necessarily declining yet, but we'll see more evidence. We've seen some evidence that the core PCE inflation is perhaps either reaching a peak or flattening out. We'll want to know more than just some evidence. We'll want to really feel like we're making some progress there. But I mean, we're going to make these decisions, and there'll be a lot more information. I just think we want to see that information as we get there. It's a very difficult environment to try to give forward guidance 60, 90 days in advance. There are just so many things that can happen in the economy and around the world. So, we're leaving ourselves room to look at the data and make a decision as we get there.
I'm sorry, but if inflation is lower 1 month and the unemployment rate higher, would that be something that we would calibrate towards a lower increase in the funds rate, or
I don't think
if
a
those are-
1 month is not, no. 1 month's reading doesn't tell us much. We'd want to see evidence that inflation is moving in a direction that gives us more comfort.
He wants to move
As I said,
slow.
we've got 2 months
very
now
slow.
where core inflation is a little lower, but we're not looking at that as a reason to take some comfort. I think we need to really see that our expectation is being fulfilled, that inflation, in fact, is under control and starting to come down. But again, it's not like we would stop. We would just go back to 25 basis point increases. It'll be a judgment call when these meetings arrive. But again, our expectation is, if we see what we expect to see, then we would have 50 basis point increases on the table at the next 2 meetings.
Thanks. Let's go to Colby.
Thank you. Colby Smith from the Financial Times. Given the expectation that inflation will remain well above the Fed's target at year end, what constitutes a neutral policy setting in terms of the Fed funds rate? And to what extent is it appropriate for policy to move beyond that level at some point this year?
So, neutral. When we talk about the neutral rate, we're really talking about the rate that neither pushes economic activity higher nor slows it down. So it's a concept, really. It's not something we can identify with any precision. So we estimate it within broad bands of uncertainty. And the current estimates on the committee are sort of 2 to 3%. And also, that's a longer run estimate. That's an estimate for an economy that's at full employment and 2% inflation. So really what we're doing is we're raising rates expeditiously to what we see as the broad range of plausible levels of neutral. But we know that there's not a bright line drawn on the road that tells us when we get there. So we're going to be looking at financial conditions, right? Our policy affects financial conditions, and financial conditions affect the economy. So we're going to be looking at the effect of our policy moves on financial conditions. Are they tightening appropriately? And then we're going to be looking at the effects on the economy. And we're going to be making a judgment about whether we've done enough to get us on a path to restore price stability. It's that. So if that path happens to evolve levels that are higher than estimates of neutral, then we will not hesitate to go to those levels. We won't. But again, there's a sort of false precision in the discussion that we as policymakers don't really feel. You're going to raise rates, and you're going to be kind of inquiring how that is affecting the economy through financial conditions. And of course, if higher rates are required, then we won't hesitate to deliver them.
Neil.
Thanks, Chair Powell. Neil Irwin with Axios. Do you see evidence that inflationary psychology is changing, that in areas like workers' wage demands, businesses' willingness to raise prices, do you see evidence that there is a psychological shift going on inflation? Thanks.
So we don't really see strong.
All right, I think we got the what we needed to get out of Powell, man. So basically, the market's reacting right now to that. There's no 75 basis points on the table right now. 50 basis point increments. They're going to want to look at more data. Keep it slow. Keep chugging along. Try to maintain the 50 basis points, so there's not going to be any surprises. And that's what we talked about. That's what we talked about before the numbers came out. Is so far the Fed hasn't deviated from what they've been saying, right? They don't want to shock the market any more than they need to, unless they need to. Is basically what he said. There's not going to be any hesitation. He said if we need to raise rates higher, we will, but right now we're just going to chill. Which chilling is kind of what got us into this mess. But I mean, I get it. I mean, they're raising rates 50 basis points. I mean, that's not like a small amount, right? So they're raising rates 50 basis points. The market's reacting. There's not going to be like a 1% rate hike randomly unless the market calls for it. But still, I'm not really a buyer of this right here. So right now we're testing. I mean, S&P is testing the 10-day moving average, which I was kind of looking for. Nasdaq testing it as well. So this is the first test again on the Nasdaq since April 21st. I want to see some follow through here. You know, I mean, on the Nasdaq, can we come up to the 50-day? I think so. But I mean, kind of depends on if they try to lay in here. You know, I mean, I want some bullish days ahead. I do. It's just been hard. It's been very hard to be a bull. Okay, so S&P, we touched some low. We revisited the lows of the day in the S&P, and then we ripped back up. So I mean, anything could happen. We still have over an hour left in the trading session. Like anything could happen here. We could rip to infinity. We could crash, but right now, I mean, Dow's up 500 almost. Nasdaq's almost up 200. S&P's almost up 60. I mean, this is insane. This is insane. But I mean, like for me, I'm not willing to gamble my money to ride this roller coaster. I mean, I made some money this morning. I'm good with that. You know, I don't need every single move, and I don't trade afternoons anyways. Like I just don't trade them. But I mean, this is gonna be interesting, guys. This is gonna be interesting. I mean, kind of what we've been saying this whole time is, you know, keep some capital, take it easy, and make money. Like it's. I know we tend to overthink things, but I think in this market, let's just keep it simple. Take it a trade at a time. Take it a day at a time. Not try to forecast the 2 months from now, because we don't know what's going to happen. We don't know what's going to happen here. So, with that being said, I'm going to take off, guys. It was fun hanging out. As always, you guys stay safe, stay green. It's us versus herd.